Hello everyone, welcome back to my channel. I'd like to discuss a very serious issue that is damaging the world economy and may have a significant influence on your finances. When banks are in trouble, they become very careful with their money, which means fewer mortgages, fewer business property loans, fewer automobile loans, and fewer loans for credit are granted. So, it should be of great worry to all of us that US banks are currently losing deposits at an alarming rate. If you're living in the US, you probably want to pay attention to this. The US economy is on the brink of collapse. The economies of the world nations will also get affected due to this economic crisis, since a lot of countries are associated with American services and their finances. What do you mean by a credit squeeze? A credit squeeze occurs when individuals and businesses find it more difficult to obtain credit or loans from financial institutions such as banks. This can arise for a variety of causes, including a decline in credit availability owing to economic conditions or changes in government policy, an increase in credit demand that exceeds available supply, or a combination of the two. Lending institutions may tighten lending rules, raise interest rates, or restrict the amount of credit accessible to borrowers during a credit crunch. Individuals and organizations may find it more difficult to secure the finance they require to engage in new initiatives, grow their operations, or pay their financial responsibilities as a result of this. Credit squeezes can harm the economy as a whole by slowing economic growth, causing job losses, and causing financial difficulties for individuals and enterprises. Why is this happening now? Various elements contribute to the credit crunch. One is rising inflation, which is reducing money's purchasing value and requiring central banks to hike interest rates to combat it. A lot of money was pulled out of the banks as deposit outflow. The challenge that deposit outflows pose for all banks is that raising deposit rates to retain customers may make them less profitable, but losing too many customers, as Silicon Valley Bank did, means giving up critical funding and possibly having to sell assets at a loss to cover withdrawals. Customers at Silicon Valley Bank withdrew $42 billion in a single day, leaving the bank with a negative cash balance of $958 million. When a large number of depositors withdraw their funds, banks may be forced to liquidate assets to maintain adequate liquidity. But American banks are currently sitting on a huge account of unrecognized liabilities. The US Federal Reserve was cautioned not to raise interest rates so quickly, but did so anyway, and they have contributed to the collapse of the US financial system. Small banks, it turns out, are becoming extremely frugal with their funds. Commercial bank lending fell about $105 billion in the 2 weeks ending March 29th, the largest reduction in Federal Reserve data dating back to 1973. Loans are not being lent out as easily as before. Another reason is the energy problem, which is raising manufacturing and transportation costs and reducing business earnings. A third source of uncertainty and risk aversion among investors and lenders is geopolitical instability. What are the consequences of the credit squeeze? The credit crunch can have major negative consequences for the economy and consumers, such as: Number 1. Economic slowdown. A credit crunch can have a knock-on effect on the economy, lowering investment, slowing growth, and causing job losses. This has the potential to cause a broader economic slowdown or recession. Number 2. Market volatility. A credit squeeze can exacerbate market volatility, with stock prices and other financial assets falling sharply. This can lead to investment losses and generate uncertainty in financial markets. Number 3. It has the potential to increase unemployment if businesses reduce hiring or lay off workers due to decreasing demand and profitability. Number 4. It can exacerbate the debt burden as borrowers struggle to repay or default on their loans as interest rates rise and income falls. Number 5. Individuals and businesses in financial distress. When credit becomes scarce or expensive, individuals and businesses may struggle to pay payments, satisfy financial obligations, or invest in new ventures. This might result in financial hardship, job loss, and even bankruptcy. Number 6. Reduced credit availability. During a credit crunch, banks and other lenders may tighten lending rules, reduce loan availability, or raise interest rates. This can make credit more difficult to get for individuals and firms, slowing economic growth and limiting investment. For a more detailed explanation of things, we need to get specific. According to Jamie Dimon of JP Morgan Chase & Co.'s, the banking crisis has increased the likelihood of a recession. In an annual letter, the bank's CEO stated that the failures provoke lots of jitters in the market and will clearly cause some tightening of financial conditions as banks and other lenders become more conservative. Even if current rates remain unchanged, new lending rates are projected to be 3.5 to 4.5 percentage points higher than rates on many existing CRE mortgages. This new credit crisis threatens to become uncontrollable, but Fed officials swear that everything is great. Despite financial stability worries following the second largest banking collapse in US history, Fed officials raised interest rates by a quarter percentage point last month, continuing their aggressive year-long drive to contain value rises. A bold move, but is it sustainable? Now, let's talk shop. Take a look at the Credit Conditions Index. The headline credit index declined 6.7 points in quarter 2 to 5.8, its lowest level since the outbreak of the epidemic. The figure shows widespread predictions for deteriorating credit market conditions. In the second quarter, the Consumer Credit Index plummeted 7.9 points to 5.8. Credit availability is expected to decrease more than credit quality. However, both are expected to decline. The number below 50 suggests that consumer credit conditions are likely to deteriorate over the following 6 months. In the second quarter, the Corporate Credit Index declined 5.6 points to 5.8. All EAC members anticipate a decline in business credit availability during the next 6 months, and the majority anticipate a decline in business credit quality. A rating below 50 implies that EAC members expect overall credit conditions for firms to worsen during the next 2 quarters. Any figure less than 50 is considered terrible, and those figures are in the single digits. That shows the present condition. How can you protect yourself from the oncoming credit squeeze? It can be difficult to completely insulate oneself against a credit squeeze because these events are frequently driven by wider economic forces outside one's control. However, there are several things you may take to reduce the financial impact of a credit squeeze. Number 1. Pay off your high-interest debt as soon as possible, particularly credit card debt, which is approaching $1 trillion in the United States, a 15% increase from the previous year. Number 2, increase your savings and create an emergency fund that can cover at least 6 months of living expenditures in the event of a job loss or income cut. Having a financial cushion in place can help you manage unexpected financial setbacks and avoid taking on debt during a credit squeeze. Number 3, reduce your spending and budget carefully, concentrating on your most important necessities and eliminating superfluous purchases or subscriptions. Number 4, expand your sources of income and invest sensibly, seeking possibilities with consistent returns and minimal risks, such as dividend stocks or bonds. Number 5, diversify your credit sources. Think about using peer-to-peer lending platforms or credit unions, which may be less affected by a credit squeeze than traditional banks. Number 6, improve your credit score. A higher credit score can help you qualify for cheaper interest rates and increase your chances of being approved for credit during a credit crunch. Number 7, keep up to date. Keep an eye on economic indicators and remain current on financial news and developments to predict probable credit squeeze events and alter your financial strategies accordingly. The credit crunch is here, and it is not going away anytime soon. The International Monetary Fund has warned that the worst is yet to come for the global economy. To ensure your financial future, you must be aware of the situation and take action. If you enjoyed this video, please like, share, and subscribe to my channel for more similar stuff. Also, don't forget to read the references listed in the description below for more information on this subject. Thank you for viewing it, and I hope to see you again in the next video.